Brad Williams, Frugal Finance, the reversing trade and hedging. What does this mean? Looking into futures forwards. One particular feature of these transactions is that the manufacturer did not accept delivery on the futures contract, but offset the contract instead. Rather than accepting delivery on a contract, it usually is better to reverse the trade. In other words, they just buy it back. They just offset that trade because offsetting saves on transaction costs and administrative difficulty. So you buy the contract, then you just sell it instead of taking delivery. And there's a lot of reasons why you would do that, and I'll explain. The short trader has the right to choose. There is just some nastiness, nasty gamesmanship. Remember, you are supposed to be sophisticated. You are supposed to understand the rules. You had better know every word of the requirements on a futures trade. It's a lengthy document, but if you're trading silver, the requirements are specific and exact. There's no negotiation here. But there's some serious manipulation here. And because there's very little inspection, there's little enforcement, there are some shady characters out there. Okay. The short trader has the right to choose the delivery destination, and the long trader must fear that the short trader will select an unpalatable destination. That's the problem here. Instead of taking delivery, the long trader can acquire the physical commodity from normal suppliers. A hedger, in this example, could have achieved the same result by accepting delivery. If delivery were accepted on the futures contract, the silver would have been secured at a price of 106.8 cents per ounce, which is what happened when the reversing trade was used. Why would you go through unless you absolutely positively need delivery? Why would you take it? Well, in some cases, you might have to. But in other cases, you probably want to avoid it at all costs. A short hedge, although the long silver hedge involved the purchase of future contract, hedges do not necessarily involve long futures position. A short hedge is a hedge in which the hedger sells a future contract. As an example, we assume the same silver prices and a date of May 10th as shown in Table 4.7. A Nevada silver mine owner is concerned about the price of silver since she wants to be able to plan for the profitability of her firm. If silver prices fall, she may be forced to suspend production. Given the current level of production, she expects to have about 50,000 ounces of silver ready for shipment in 2 months. Considering the silver prices shown in 4.7, she decides that she'd be satisfied to receive 1,068 cents per ounce for her silver. To establish the price of 106.8 cents per ounce, the mine owner decides to enter the silver's future market. By hedging, she can avoid the risk that silver prices might fall in the next 2 months. Table 4.9 shows the miner's transaction. Notice that these are exactly the mirror images of the film manufacturer's transaction. Anticipating the need to sell 50,000 ounces of silver in 2 months, the mine owner sells 10 5,000-ounce future contracts for July delivery at 1,060 cents per ounce. On July 10th, with silver prices at 107.1 cents per ounce, the mine owner sells the silver and receives $535,000. This is $1,500 more than she originally expected. In the futures market, however, the mine owner suffers an offsetting loss. The future contract she sold at 106.8 cents per ounce, she offsets in July at 107.1 cents per ounce. Once again, the profits and losses in the two markets offset each other and produce a net wealth of change of zero. Viewing the results from the vantage point of July, it is clear that the mine owner would have been $1,500 richer if she had not hedged. She would have received $1,500 more than originally expected in the physical market, and she would have incurred no loss in the futures market. However, it does not follow that she was unwise to hedge. The mine owner knew before establishing her hedge that she might have a higher profit margin in certain market conditions if her position was left unhedged. However, she knew that she definitely wanted to avoid a lower profit margin and therefore chose to establish a hedge position with the futures contract. In hedging, the mine owner and the film manufacturer both decided that the futures price as an acceptable price at which to complete the transaction in July. Here is the position. May 10th, a short hedge in silver. Anticipate the sale of 50,000 troy ounces in 2 months and expect to receive 106.8 cents per ounce or total 534. Sell 10 5,000 troy ounce July futures contracts at 1,068. July 10th, the spot price of silver is now 107.1 cents per ounce. The mine owner sells 50,000 ounces, receiving 535. Buys 10 contracts at 107.1 cents per ounce. Gain $1,500. Loss $1,500. Net change 0. Brad Williams, Frugal Finance. Thanks for watching.